Okay, in this video I wanted to take a quick moment to give you a little bit of an insight, a little tutorial about the market wrap video that you're watching, and give you an insight into what it is and the basis behind everything that I'm doing. So essentially I want to move this out of the way, and what I want you to know is essentially when you're looking at the market wrap video, what you're getting is a review of this is basically what we call a bottom up analysis. And really what that basically says is that you're looking at the market from a perspective of the lower time frames first, and you're looking at the lower time frames before zooming out. So the idea is that you're looking at today's action, and comparing it to yesterday's action. All right, now on top of that, the main thing that we're trying to find out is did today's action go beyond or trade beyond yesterday's extremes. Okay, and we're talking about the extremes in terms of yesterday's high and low, right? And if that is the case, then typically, if not, if yes, then there's a chance for that things could be developing. We may have to look at a bigger trend developing. Right? There's and if no, then typically it's it was basically a lack of activity, right? It was a lack of activity, and typically we could say it was a range day or an inside day. And this is a scalping day. All right, so typically, we can also say it's a choppy day. All right, the idea is that what we're trying to identify is was it a trending environment, a trending day, or a choppy day? Okay, and when we put it in the context of the previous session, we can identify if it was trending outside. Was it able to was it outside of yesterday's range? The implication here is that the institutions are moving price. This basically says that there was institutional trading. If it was choppy, then chances are, this was probably a tough trading environment. All right, so the idea is really to gauge. So we're comparing today's price action versus yesterday's price action. Once we understand that, then we take this, and then finally what we're going to do is put this into context. We're going to put this into context of the short-term swing trend. And the swing trend is typically, this is 3 days to 3 weeks of action. Okay, so this is basically the short-term swing trading analysis. And then once we do that, you can get a gauge as to looking at the idea here. So once you do that, once you take a look at the so we're looking at comparing. We compare today versus yesterday, and then we compare. Then we compare this to the short-term swing trend. So really, like if you're looking at the short-term swing trend, we're talking obviously, like I said, at 3 days to 3 weeks of action. And the idea here is that we're looking at are we still moving in that direction? Or this will help you be able to are we starting to see a shift? Right, so we're trying to gauge the health of the trend. So we're trying to gauge the health of the short-term swing trend. Right? And the idea here is that we're using, so how are we doing this? We're basically using the hourly charts first is what you're going to notice. So I'm looking at the hourly chart. So it's 2-day hourly chart. And we've identify yesterday's high and low. So it's always important to look at previous session high and low. Okay, so the important thing here is if we break above yesterday's high, then chances are more buyers, right? The bears are in control, or they've been able to push price beyond yesterday's highs. I mean, you can see that the bears are probably not not in control. So if we're below previous low, then probably more sellers. The closing price is very important. So that's another thing, is that if you're able to close above yesterday's high, then chances are you have more buyers than sellers, and they were able to sustain the move in that direction. And then if you, like I said, if you have price that's, let's say you have, you got yesterday's action, and then you got today's action, and you're going to have 3 different scenarios. One is that, well, let's go over here and do this here. So you have yesterday, and then you have today. And I always separate yesterday's and today's session. So scenario number one is that you break above yesterday's high. We come in, we basically chop around, and then today, boom, we're able to break out of yesterday's high. This is bullish. If you can close outside of yesterday's high, and chances are things may continue in that direction. Two is that if you're you're trading today, and then you have low. You basically make yesterday's low, and then today you're able to break out of yesterday's low to the downside. And if you're able to close, typically you could probably look for things to continue to the downside. The other alternative, the last one, is obviously the the third scenario, where the market basically does nothing. So you have yesterday's high, yesterday's low. The market basically creates those levels, and then today we basically trade in between those levels. Okay, so you can see here that it's all sideways, and then you have to be a little bit more patient. This is a tough environment. Okay, this is choppy. And really, the important thing here is to be able to know what kind of environment you're in, because if you can tell this ahead of time and really quickly, then it can tell you, like, how aggressive to be with your trades, how conservative or whatnot. Now, once you're done with that, you're just sitting there and you're like, it's kind of like coming back, and it's a quick way of gaining an understanding about what kind of environment you're in. As you develop, or as you get more acclimated to this, you'll be able to actually determine this stuff live while it's happening. Hey, this is a choppy environment. I need to be careful. I need to sit on my hands. I need to be Hey, this is an environment that's trending. Okay, we're trending upward. We're going in the direction of the trend to the upside. I want to avoid shorts. I don't want to get short. That kind of thing. Or if we're trending lower, I don't want to get long, that kind of thing. So again, then after that, what I do is I take a step back, and then knowing that, we go look at the daily chart, and look for the short-term swing trend. Okay, this is pretty important because this gives you an understanding of where price could be headed. Of the near-term trend, and like I said, this is basically 3 days to 3 weeks, but you gotta know when you could probably expect the transition in the lower time frames, in terms of, like, if you're running into a key level of resistance on the daily chart, then you know that you probably, if you got a daily chart that's coming up to, let's say, massive levels of resistance here, right? Let's say you're talking about the previous year's high or something. You got resistance. Then on the hourly chart, you're going to start looking for something like, where the market puts in a high and then breaks the low, right? So we come in, put in the high here, and then all of a sudden we break through the low, boom. And then you're gonna get your confirmation here that you're looking at, where boom, all of a sudden you can start to look short, and you're getting your confirmation here that the sellers are taking over. Okay? And then the other one is that you're going to be, you're looking at that daily chart to get a gauge of understanding for, let's say you have support, or if you have, some sort of, you got this level that's coming into play, and then you got this massive level of support on the daily chart. Well, then on the hourly, you could probably start to look for the potential for this market to start to break to the upside. So you got the high, and then you got the low, and you can see here that we're basically bouncing around, then all of a sudden, boom, you break to the upside and you have a breakout, and you're probably like, whoa, what was that all about? Well, you've basically confirmed this support level, and the bulls have essentially taken charge, okay? So that's typically how that works. Now, that's if you're looking at one currency. Now we're going to talk about why we look at the various currencies. So the main thing that you want to know in terms of stats is that the dollar is the heavily traded currency in the world, no matter what. It doesn't matter what we look at. And people can argue on and on about the fact that, hey, it's not going to be there forever or whatever. But right now, at this point, dollar is king. It is the most heavily traded currency out there. Now, the dollar is made up as a basket of the dollar index, right? That's what we look at. Dollar index futures is made up of a basket of currencies. And we know that when we come up with an index, we're basically averaging a certain number of, we're looking at currencies. So the euro, the pound, the Australian dollar, and then you have the Japanese yen, right? You got the Swiss franc, and then you got the Canadian dollar. Okay, so these are the big. This is a basket of currencies that are that make up the index, the dollar index, and the euro is number one, the biggest traded currency in relation to the dollar, and then you have the Japanese yen, which is number two, and then it kind of trickles off between all the rest of these. It's like, I think number three is the pound, and then or maybe four is the Swissy or something to this effect. But again, I'm not really. I just know that number one and number two are the euro and the yen, and so what we have to do is that to determine the action in the dollar. We have to gauge the activity, the action in the other currencies. All right. All right, and this is what we call intermarket analysis. And some others might call it, a form of Dow theory. And we'll talk about this later. But in a sense, the way it looks is that what you're going to notice is that the dollar index is comprised of these major currencies. And notice when you look at the currency pairs, how you're going to look at the ticker that is being used. You can see here the Euro USD, GBP USD, AUD USD. You can see over here it's USD JPY, USD CHF, USD CAD. Now the important thing here is where USD is in the equation. So really, if you think of this as a division problem, in terms of mathematics, just a little bit, you're dividing. So if we were to take the rate of the euro and then divide it by the dollar, we would get the current exchange rate, right? So essentially, what all you're doing is you are trading the exchange rates, and that's really what it is. Okay, so don't take it any more than that. You're trading the exchange rates, and like I said, in the euro USD, you're dividing the euro by the dollar. That's it, and this gives you whatever the current price is. Let's say it's 1.2597. That's what I'm looking at right now. And then over here, let's say you're looking at the dollar yen. So you're basically taking the dollar and you're dividing it by the Japanese yen. That's it. And you're getting what's the number over there? It's 79.37. So really, like I said, this is a division problem. That's all it is, and that's why this is an inverse correlation. You can see here that when you're looking, just a little kind of math here, is that anything that has USD as the denominator are going to be practically, they should move in the same direction. So you can see here the pound and the, think of this as other division problems that have the dollar as the denominator, right? And that's really how it works, is that what's the common denominator here is the dollar. And that means that if you cancel this out, you can look at these currencies and they should move in the same direction. On the flip side, the common numerator is the dollar. All right, so essentially the way it looks is that over here you have just kind of do a little bit of math, euro, and then we got the pound, and then we got the Aussie, and then it's all over USD. So that means that these should move in the same direction. And then over here you have the USD over the pound, Swissy, and the Canadian. And that means that all these should move in the same direction. All right, so just basically telling you that if the dollar is moving in one direction, if the dollar is moving up, then typically these should go up. If the dollar is moving up, then typically these should go down. Now, this may be a little confusing, but don't worry about it, because when you're actually looking at the markets, then we'll show you how that works. Now, the caveat at this point is that the Japanese yen has a tendency to be a little bit of a misfit right now because of the carry trade. The carry trade just is basically, go look it up. It deals with the exchange rates and how it has something to do with the interest rates. The interest rates are so low in Japan that people are borrowing yen and they're investing it in other economies. And that's really driving the weird price action that you see in terms of the dollar yen, why it's not really correlating. So let's just take a quick moment and let me zoom out here and let me show you what I'm talking about again. That essentially what we're looking at here is the dashboard. This is what we see every day. And like I said, the idea here is that you have the dollar on a 1 hour chart, and then you have the dollar yen, the Swiss franc, and the Canadian across the top. You have the euro, the pound, and the Australian dollar across the bottom. And like I said, if the dollar goes up, chances are I want the yen, Swiss franc, and the Canadian dollar to go up. And I want the euro, the pound, and the Australian dollar to go down. And you'll see this constantly over and over and over again, with an exception of the Japanese yen. The Japanese yen right now is decoupled from this scenario, but I still keep it up here because it's a very important part of the dollar index, and because I do trade it from time to time. But from an intraday basis, when I'm looking at the correlations, I mean, even just looking at this right here, you can see here the dollar went down and the euro went up. The pound didn't go down too much, and neither did the Australian dollar, but sometimes it doesn't line up very well, and majority of the time it will be where this will go down and all three of these will, or excuse me, this will go down and all three of these will go up. Look at this. Sorry, I misspoke a minute ago. But you can see how the euro went up, the pound was up, the Australian dollar was up. At the same time that the dollar was down over here, even you can see that the yen was down, the Swissy was down, the Canadian dollar was down. So basically, the important thing is what we're using is the dollar as an anchor, or like I say, the puppet master. And then these are positively correlated. And then these down here are negative correlation. Alright, so that's pretty much it. And then, like I said, once we take a look at the hourly chart, look at today versus yesterday, then I go look at the daily charts, and I do the same kind of analysis, except I'm just looking at key moving averages. But you can see the daily charts here with the currencies that we look at, and essentially you got the dollar, you got the yen, Swissy, Canadian, you got the euro, pound, Aussie. And, you know, this basically is, you know, the second piece of the puzzle when we talk about the view from 30,000 feet, you know, kind of like the bird's eye view to see, hey, what can we expect over the next couple of days, couple of weeks in the trends to come. So, again, that's all I got. And really what you're trying to do is to gauge what the dollar is doing and then determine, you know, what that says about the other currencies. And if you're new to this, only stick to the euro and the dollar. I think that'll be plenty of you know, insight for you to trade. So I hope it helps. Good luck in your trading. We'll see you at the next webinar.